Hi everyone. If you're a US based NRI or an investor wanting exposure in Indian market, I have some crucial information that could save you from tax nightmare and potentially tens of thousands of dollars. So stay with me because understanding this could be the difference between keeping your gains and handing them over to IRS. Today we are talking about a non-PFIC option which probably most of US investors were waiting for. In this video we will see what is that option, why is it suitable for US investors, and what are the tax implications of it. Especially for US investors, understanding tax implication is so important because with your green card, passport or tax residency, US has power to tax your global income. If you are new to this channel, I am CS Keerthi now based out of Dubai. I am a CS, CMA strategic level and SCA AMFI registered. I run the consultancy, a firm which is specialized in NRI services. We do cross-border taxation advisory and goal-based investment, assisting thousands of NRIs. In this channel, I want to keep giving different perspectives, awareness of compliance landscape, which means I must commit few hours of every day to create that content. I have noticed that many of you simply view my content and never subscribe. If you are just scrolling without subscribing, please do subscribe because it helps to reach many NRIs and serves a basic purpose for which I commit my time and expertise and try every day. And you can always unsubscribe if you don't like this channel. So please press the subscribe button. Now let's start with the problem. In my consultation calls in last 3-4 years, I've come across many people who were not aware of tax treatments of be it ETFs or mutual funds, especially in US, who invested in India, and some of them chose to ignore, thinking that FATCA will not affect them, though they don't know the implication of that. So I've made a detailed video of what is PFIC, since I was not onboarding any US investors till this option came. You can watch here if you are a US investor, because you must understand that investing in ETF or passive vehicle like mutual fund can be disaster for you. Here is why. Indian MFs are classified as PFICs, passive foreign investment companies by IRS, and PFIC taxation is absolutely brutal. We are talking about effective tax of 40 to 50% or even more, higher tax rate plus punitive interest charges on the gain. You have to file this form 8621 every single year for every PFIC you own. The form is so complex that most of the CPAs will not even touch it, especially under QEF. And those who do, they will charge anywhere between 500 to 2,000 per fund per year. Imagine owning 5 of such PFICs, up to 10,000 is just gone in reporting before even you pay the actual taxes. And here is a kicker. Under PFIC rules, you might pay tax on unrealized gains, money that you haven't even received. You could watch your investment drop 30% next year, still owe taxes to the IRS for the previous year's so-called on paper gains. So for most of the US investors, this makes direct ETF or MF investing completely impractical. So I myself never onboarded anyone and kept hoping for some magical solution to appear. Because you see, diversification is must for NRIs. Hedging was never so important than today's time for US investors, but solution was not there till this came. So what is that solution? AIFs in GIFT City, and why they might be single best structure for US investors to access Indian equities, I am going to explain in this. See, the strategy is simple. Enter GIFT City Non-PFIC AIFs, and this is going to be a game changer. GIFT City is India's first international financial services center. Think of it as India's answer to Dubai or Singapore, a special SEZ with its own regulatory framework. That's why it is very special. Funds in GIFT City are technically offshore, even though they are physically located in India. They are denominated in foreign currencies like USD, and they are regulated not by SEBI but IFSCA, IFSCA. But here is a brilliant part of it. Category 3 AIFs or alternative investment funds, they can be structured as non-PFIC. How? By filing IRS form 8832 and electing to be one of the corporation for US tax purpose. The fund pays tax in India at fund level, be it 12.5% LTCG or 20% in the short term, and passes already taxed income to the investors. So this completely has sidestepped PFIC classification for IRs. So remember, the non-PFIC status always depends on the entity classification election. What I have mentioned, Form 8832. The fund has to be treated as a corporation, not as a partnership for US tax purpose. Second, foreign income test. By paying Indian tax at the fund level, the income becomes effectively connected income or already taxed foreign income. Third, active business exception. Some AIFs may qualify even under this active business exception if they meet certain trading threshold. So this is an important caveat everyone has to understand. Not all GIFT City AIFs automatically fall under this non-PFIC. It depends on the specific fund structure, whether they have filed Form 8832 or the fund's investment activities or income composition comply with that. So just don't blindly go and invest in some random structure and voluntarily walk into any trap again. So if you want any handheld journey or guidance in exploring this option, you can always mail us at info@keerthisfinfo.com or contact us by texting this number. Now let's get back to the topic. How the tax implication or how the taxation works. Let's break it down exactly how this works for you as an US investor. First, in India, the fund itself is paying the tax on realized gain as and when it is trading. And for US, you will receive K1 form showing your share of the fund's gain. So you are reporting this on your US tax return and pay US capital gain tax. Here is where it gets too good. LTCG maybe at 0%, 15%, 20%, depending on your income tax slab rate, and most of the investors, you fall in 15 to 20%. So you can also claim FTC or foreign tax credit. See, if you have invested $150,000 and made $50,000 gain in PFIC route, you would have paid $20,000 or more in taxes plus thousands in compliance cost. But for non-PFIC AIF structure in this route, India might take $6,300 US takes as per your income tax slab rate. So you avoid the compliance nightmare. So understand the key advantages here. Beyond tax efficiency, I would say that there are 4 more reasons why non-PFIC AIFs are superior. First, hedging. As Ray Dalio always speaks of holy grain theory, when you feel inflation debt level is going so high in country like US, the best way is to heavily diversify in assets, geography that has low or no correlation. So it's multi-asset, multi-currency, multi-geography, which is my mantra and should be your mantra. Second, simple compliance. Instead of filing complex form 8621 for each fund and you just report your K1 like any other partnership investment, your CPA can handle this. You are a partner and not a PFIC investor. Third, you're trusting best brains to handle your money, or you have access to top Indian fund managers. See, the fund houses like HDFC, Motilal or ICICI, Parag, these premier asset managers are handling your money in a US friendly structure. They, if you check, would have given brilliant results for decades. And that research expertise you are tapping on. This confidence is so much better than we doing stock investment by ourselves, because most of the time, trust me, we confuse short-term profit over consistent gain. And mostly we don't even realize that we are not beating MF returns and killed our compounding journey. So you can avoid this. Fourth is clean repatriation. When you want your money back, it's fully repatriable to the country that you're residing with no RBI cap or approval, no forms, no withholding tax. Your funds stay in dollars entire time. Last one, zero tax in India at the redemption. So Indian taxation is out of the picture. You have already paid taxes at fund level. When you exit, you receive full net amount reflected in NAV. No DTAA filing 2 times tax return, no hassles. So now let me be very clear about the requirements and the limitations. Because see, AIFs typically require entry level of 150,000, so it's not for all. They're designed for typically high net worth individuals who can stay invested for 5 to 10 years. There is no specific lock-in period in most of the funds, but there can be high exit load. Understand, not all AIFs are non-PFIC. You must specifically confirm that the fund has filed 8832 and is structured to avoid PFIC classification. Get this in writing, otherwise it will be very costly. For US investors who always wanted market exposure for hedging purposes, or they have something more to invest for long term, non-PFIC AIFs represent most tax efficient structure available today. You get professional Indian equity management, favorable US tax treatment, simple compliance, none of PFIC headaches that makes direct mutual fund investing a nightmare, right? If you are someone who want to invest in this non-PFIC structure, we can help you out. Contact us by WhatsApping this number or mailing it info@FinFo, because trust me, this is truly a game changer. If you find this helpful, hit the like button and subscribe for more of such content. See you next week with another interesting topic. Till then, bye-bye.